Welcome to today's Explainer. I am absolutely thrilled you're here with us right now because, well, we are looking at a truly monumental moment in global finance. We're going to break down Kevin Warsh's very first policy decision as the 17th chair of the Federal Reserve. And look, this wasn't just some routine, run-of-the-mill meeting. It marks a fundamental paradigm shift in U.S. monetary policy. So we're going to look closely at the data, the institutional changes, and the massive global ripple effects of this debut.
Here's a quick roadmap of where we're headed. We'll start with the high-stakes Fed debut, decode that high inflation data, check out the new communication playbook, navigate the intense political pressure, and wrap up with the global market impacts.
All right, Section 1, a high-stakes Fed debut. Let's dive right in.
So the big headline out of the June 17th meeting was that the Federal Reserve held its benchmark interest rate totally unchanged, sitting right there in the 3.50% to 3.75% range. Now, context is everything here, right? This marks the fourth consecutive meeting where they've held rates steady. In fact, the last time the committee actually moved rates was a cut way back in December 2025. So for literally half a year now, we've just been sitting in this exact holding pattern.
But here's the thing you gotta know. The hold itself, not a surprise at all. If you look at the CME Fed Watch, which is basically a futures pricing tracker that tells us what the market is betting on, it put the odds of a rate hold at roughly 97% just days before the meeting. The market completely expected this. So the actual rate hold was ironically kind of the least consequential part of the whole meeting. The real story is everything happening around that number. Moving to Section 2, decoding high inflation data. Because we really need to look at the economic backdrop that forced Warsh's hand here.
Okay, the crucial point is this specific number, 4.2%. May's consumer price index surged to a massive 4.2%. And look, this isn't just a tiny negligible bump. This is a 3-year high. We literally haven't seen inflation at this level since April 2023. This was the primary glaring challenge staring Chair Warsh in the face as he walked into his very first meeting. I mean, you just cannot ignore a 4.2% inflation print.
But what's really fascinating is how that 4.2% is actually built. It's not just a uniform across-the-board rise in prices. Over 60% of that monthly CPI spike was driven almost entirely by energy prices, which, as we know, are super elevated right now due to the geopolitical tensions over in the Strait of Hormuz. Now, if you strip out that energy factor, core CPI on a monthly basis actually came in quite low at just 0.2%, which was even below what forecasters expected. This distinction is absolutely vital. It's what gives Warsh the breathing room to hold a firm line on inflation without completely panicking and triggering an immediate rate hike.
That being said, it's not just inflation. The broader economy is just running hot. The US added 172,000 jobs, far exceeding expectations. And this resilient job market, combined with that 4.2% headline inflation, has functionally killed any lingering hope of an easing bias. You know, the old assumption that rates are only going down from here. Just look at how the big players are reacting. Goldman Sachs completely scrapped its forecast for a December 2026 rate cut and pushed it all the way out to 2027. Bank of America even flagged that at least 3 Fed members are actually projecting rate hikes in 2026. So the path forward, it's strictly hold or hike. The easing cycle is over, folks.
Section 3, the new communication playbook. With the data dictating this really tough stance, the institution's messaging is fundamentally changing.
We are witnessing a brilliant, massive structural shift. Think about the old Fed era. 8 meetings a year, maintaining that easing bias, and relying incredibly heavily on the dot plot, which is the Fed's internal forecast of future interest rates to anchor market expectations. Now, contrast that with the emerging Warsh era. We're looking at potentially dropping down to just 4 meetings a year. We're seeing the formal removal of the easing bias from their actual policy statements, but maybe the most symbolically significant thing of all, Warsh is expected to withhold his own dot plot entry. I mean, wow. A Fed chair declining to anchor market expectations through a mechanism the institution has relied on for over a decade? He clearly wants way fewer interventions and way more data dependence.
I absolutely love this quote because it just perfectly summarizes his entire philosophy. Speaking to the International Monetary Fund, Warsh said, "The central bank should find new comfort in working without applause and without the audience at the edge of its seats." He really envisions a quieter central bank, one that doesn't feel the need to hold a massive press conference after every single session, just one that puts its head down, does the work behind the scenes, and lets the data do the talking.
Moving on to Section 4, navigating intense political pressure. Because of course, no Fed chair operates in a vacuum.
Let's look at the facts of the political environment here.
Just consider the incredibly compressed, unbelievably high-pressure timeline Warsh has faced in just his first month. On May 13th, he was confirmed by the Senate in a 54-45 vote. And our sources note this was literally the most partisan confirmation of a Federal Reserve chair in history. Then, just 9 days later, on May 22nd, he takes the oath of office. Fast forward to June 17th, and he's already presiding over his first highly scrutinized rate decision. Talk about a rapid baptism by fire.
And what really adds to that pressure are the dynamics of how he got the job. Donald Trump picked Kevin Warsh with the explicitly stated desire for lower interest rates, having previously been pretty critical of Jerome Powell for not cutting rates fast enough. Ahead of this very meeting, Trump publicly stated that there was zero reason to raise rates and that the Fed should be lowering them. Looking at this purely as an impartial observer, it's pretty clear this puts Warsh in a uniquely difficult position. The data, like that 4.2% inflation print we talked about, demands a hawkish stance. But taking that stance could be viewed politically as a betrayal by the very person who appointed him. It's a complex dynamic, for sure.
Finally, Section 5, Global Emerging Market Impacts. Because what happens in Washington definitely does not stay in Washington.
A higher-for-longer Fed rate creates this massive, cascading effect all over the globe. When the U.S. removes its easing bias, capital flows instantly reprice globally. First off, it supports a stronger U.S. dollar, which immediately puts really heavy pressure on commodity-linked currencies like the South African rand. Secondly, this ends up constraining central banks abroad. So a hawkish Warsh actually narrows the space for the South African Reserve Bank to ease their own rates because doing so could risk currency depreciation and importing even more inflation. And finally, it results in a generally higher cost of capital. For African nations and corporations holding U.S. dollar-denominated debt, the signal is loud and clear. Borrowing costs are not coming down in 2026. This forces an immediate repricing and planning horizons everywhere from Johannesburg to Lagos to Nairobi.
And that leads us to the absolute definitive takeaway from today's explainer, which is beautifully captured right here by our source. The environment of cheap and abundant dollar liquidity is not returning. The era of easy monetary accommodation is over. It's a game changer. The decisions made by businesses, treasuries, and investors globally must now fundamentally shift to reflect this brand new reality.
Which leaves us with this final, somewhat provocative thought to chew on. With the era of easy money officially over, how exactly will global markets adapt to a silent, data-dependent, and surprisingly hawkish Fed? Kevin Warsh has clearly set the stage. The old playbook is out the window and a new, much quieter but perhaps significantly more formidable era has begun. Thank you so much for hanging out with me for this explainer. Keep your eyes on the data, keep asking those right questions, and I'll catch you next time.